So if we look at the year, as Peter pointed out, it's been a very, very choppy year. And it wasn't a year where you could just say, I want equities, and you buy equities, or I don't want bonds, and you avoid bonds. Because as you can see, when I look across the asset class spectrum, to be honest, there are very few bars that go up. And so this was a year where you really wanted to be intra-asset class. You wanted to drop down and really understand, okay, exactly what am I buying? What trends am I trying to exploit? And I think this is one of the key stories of 2015. And to be honest, we think that continues into 2016. When we look in the bond market, kind of the trend that we've been talking about for actually quite a long time, this idea that a few years ago you were a bond investor, you wanted income and capital gain. And we were seeing equity-like returns. People would get 5%, 7%. They would feel very good. I'm in low volatility assets. I'm buying bonds. But now what we're looking at in bonds is essentially you're getting coupon, and you're getting coupon if you're lucky. But I think one of the key things about this chart, when you see this kind of flattish returns in a lot of asset classes, this is the year, 2015, and we think 2016, where active allocation decisions and active management is going to add a lot of value. And we've seen this in a lot of asset classes. So just because the asset classes perform relatively poorly, we've seen this, for example, in high yield, you can find managers who are adding a lot of value by finding the right stocks, finding the right bonds, and really beating the peer group. And that's something we think we do particularly well, helping to find those fund managers and having those fund managers find those stocks. And that will be a key thing, again, we think in 2016. So let's talk about 2016 a little bit and what we're looking at. If I'm honest with you, our base case for 2016 is not that different than 2015. We think the economies will continue to recover, this yellow line, and the trajectory will remain roughly the same as we saw in 2015. When we talk about numbers on a global growth perspective, you're talking about 3.5% global growth. We think it will continue to be led by developed markets. And so you say, oh, okay, wow, that's great. What's new? One of the things we want to keep in people's mind, I had this question, we were in Basel yesterday evening, when the client said, oh, this is a great story. Does this mean the European crisis is over? And I think the answer to that question is actually no, it's not. And that's largely because the debt that sits on government and corporate balance sheets is still there. And so we want to keep in mind this red scenario. That is something we are concerned about and something we are staying on top of, because this is how we're managing risk this year. But one of the things that we're really happy about, we're starting to see, is that credit growth is starting to improve and accelerate, not just in the US, but we're seeing the same trends in Europe, we're seeing them in Japan, and we're starting to see the early stages of that in the emerging markets as well. And so this breadth of growth, it is no longer just the consumer, corporates are starting to get into the act, the credit growth is starting to get into the act, and this is a more normal cycle than what we've seen in the past. So from a recovery perspective, recovery is on track, but it is one of slow, moderate, evenly paced recovery rather than kind of what we saw pre-2008. It really is about moderating expectations now. And we look at the returns this year and we say, this year was not, 2015 was not a great year for returns. Unfortunately, to be completely honest, that may be a natural type of return we should expect. So we're expecting very moderate returns. Again, let's call it mid-high single-digit type of returns in equity. And again, what I will characterize as coupon kinds of returns in bonds. And so I think the expectation of return is a key part of how we're going to shape the outlook for 2016. This idea that overall returns will be low, and we need to find different ways to add value. And we'll talk about how we want to add value in the asset classes. Really what I mean is when we look at sectors and we look at companies, you're going to see much bigger dispersion in terms of their ability to generate earnings growth. And that's exactly what we've started to see. 2015 was a great example of that. I mean, if you were in things like healthcare, if you were in things like technology, earnings growth really carried the way for you. But if you happen to be in things like financials, if you happen to be in sectors like energy, those were very challenged in 2015 because they couldn't deliver earnings. So this earnings story is going to be the key story for 2016. And again, we think global healthcare is going to be a key part of that. Good, sustainable earnings growth, innovation in the sector really driving that earnings growth. And again, technology as it takes share from the old economy and generates growth within what is otherwise a kind of stagnant global economy. We think those stories are going to be very important in 2016. So a couple key messages. Again, the story of moderate growth, I think, is an important one. I think there are a lot of people out there, the Fed is raising rates. Don't we have to be worried because they're going to raise rates very rapidly? Our answer is no, because growth is going to be moderate. You have this underlying vein of deflation in the global economy, and that means policymakers are going to take their time in terms of tightening in the U.S. But what it does mean is the strength in the U.S. dollar is going to persist, but we think it's going to, again, be much more gradual than we've seen in 2015. And I think that's going to be a key theme within portfolios in terms of generating return. The equity bull market that's been going on for a number of years, we think it continues for at least one more year in 2016. Again, because this is a year where we think earnings start coming into the picture and expectations are low. We think those beats and their ability to beat expectations on earnings is going to be key. I think Europe, healthcare, and technology are the places you're going to want to focus on for 2016. And really, in the fixed income space, once again, we want to manage our risk exposure in fixed income and really look to coupons as the kind of returns we should expect in 2016 going forward.
Because we have this great opportunity in Switzerland that we have a very high quality market, which is precisely, I think, what Norman in some ways referred to, that as we go into this low growth environment, or continue in a low-growth environment that we've been in over the last few years, it's going to be key to buy quality companies which have that competitive edge which will allow them to continue to grow even in an environment which is not sustained by a higher level of growth. And we really feel that Switzerland offers a tremendous number of companies which have those characteristics. So is the SPI against MSCI World expressed in Swiss francs over the long term. As a Swiss franc investor, you probably don't need to buy any other kind of equity except for Swiss equity when you see this kind of performance. Obviously, one needs to be diversified and one needs to take advantage of all the different products that UBP sells, but we are fortunate that we have a very good quality market in Switzerland. And not only does it outperform against MSCI, but when you look at some of the statistics on the right-hand side, you can see that the level of risk that you take in investing in Switzerland is also very measured compared with some other indices. They are fully global. They're often global leaders. So we're a tiny country, 8 million inhabitants, 3/4% of it is uninhabited and is mountains. And yet we can generate, I'd say about 70 of our 220 companies in Switzerland are global leaders in terms of their market share in whatever product they do. So obviously we have some household names here with Nestlé, Roche, Novartis could also be on that list. But some of our smaller companies have highly innovative technology, have a sustained investment in the innovation, which means that they are continually able to maintain a competitive edge over other companies, are able to bring a new product which justifies the higher labor costs because of the production in Switzerland. They have a certain amount of pricing power, notably perhaps in the luxury goods, we could say, which means that we can continue to have that special edge which will help our equity market to perform going forward. And this is the key element on the right-hand side. It's the R&D investment. We really do feel that when we're in an environment where there isn't just a need for more commodities, a need to the basics for growth, but where there's a need to show that you can do something differently, The other reason why we feel that Swiss equity can perform, so not just the fact that we think we have high-quality companies in Switzerland, is that their balance sheets also are extremely solid, and their cash generation is extremely solid. Many of you will have heard me say in the past that we always look at the cash flow return on investment of companies as the absolute best way. So where are the specific opportunities that we see for the Swiss equity market going forward? Well, we've been noticing, and I think I may have referred to it already last year, we've been intrigued by the fact that small mid-cap in Switzerland has not traded until very recently at what has been its traditional premium to the larger cap sectors in Switzerland. So where do we find specific opportunities? Again, the key point when you're looking at investing in Swiss equity over the next 12 to 18 months, perhaps even longer, is going to be identifying those companies which have that competitive edge, which have a product which disrupts the end market, which has a product which makes a real change to the end user. And those are the companies which will continue to be growing in a low-growth environment globally. We find some interesting opportunities as far as the financial sector is concerned, notably in insurance and asset management, as opposed to banks. So where do we think the Swiss equity market can go over the next 12 months? Well, we see a 7% earnings growth opportunity for Swiss companies. If we continue to see a strengthening dollar, that 7% could even be a little bit higher, all else being equal on the euro. And obviously we might, and we'll be watching very carefully for further easing measures out of Europe and how that would affect the euro. We still see that 3% dividend yield for the Swiss market as very safe going forward. There are very few companies in Switzerland, there are a couple, but a few companies in Switzerland where we can risk, or we fear the risk of a dividend cut. And finally, as I mentioned, we think that equity for Swiss franc investors remains a very attractive asset class, and that means that we would expect that equity risk premium to correct downwards and there to be some multiple expansion for the Swiss equity market. So all in all, that means that we could be seeing a 15% performance for the Swiss Performance Index in 2016, which would be very attractive. And I'd like to finish, because some people said to me last night in Basel, gosh, you're awfully optimistic. But when you think that at the beginning of this year we took a 20% hit on our currencies, and yet Switzerland has not fallen into recession, and yet we're going to end this year with a performance of the Swiss equity market which I think can possibly be a little bit above 5%, we're currently at around 4%, I think that we can be relatively optimistic with the quality of companies that we have, with the industries that they address, and with the competitive edge that they offer, that we will get that 15% performance for the Swiss equity market in 2016. Gosh, already.